Happy Friday, everybody. Hope you have a wonderful upcoming weekend. Um, so, this week I wanted to talk about the big, beautiful bill that was recently passed by the current administration and just kind of summarize some of the tax implications. Um, so I have not had continuing education on this yet. So this is just some summary information based on uh, what I have found through research. So when these tax bills go through, Congress writes the bill. I mean, this is pretty much how any legislation works. So Congress writes the bill, once it's passed and it goes to the president and signed into law, then the bill is actually given to the different governmental agencies to interpret it and implement it. And so, what can happen is an interpretation error. So the bill could end up not being implemented the way it was advertised, the way it is read, due to various limitations in software, manpower. Somebody at an agency wants to interpret it differently than what was intended. And then after it goes through the regulatory agencies, aka the IRS, then it is implemented for law, and somebody, usually with a lot of money, interprets it differently, files their tax return against the way the government agency wanted it to be, and ultimately we end up in the Supreme Court to challenge how a government agency has regulated the bill. So that's exactly how this is going to play out. The bill has been written, it has been signed, it is law, it's gone to the IRS. The IRS has to figure out how they are going to implement this. So none of this has actually gone into tax forms yet. We probably won't see how this is actually going to play out until this is going to have some significant changes on tax forms. So we probably aren't going to start seeing some of this rolled out until December, January timeframe, or even February and March. Typically, the IRS, they'll probably have some W-2 changes. Those will hopefully roll out in December since W-2s have to be filed in January. But they have been known to excuse me, the IRS has been known to make automatic extensions due to forms not being approved or finalized or ready to be submitted yet. So that might come into play on this too. Okay, so let's go ahead and talk about some of the summary stuff. So basically, the Tax Cuts Jobs Act that Trump passed in 2017 was made permanent. That was, if Trump hadn't been elected, it was estimated that it would have expired this year. Uh, he was elected, and they made that permanent. So that's not going to go nowhere. We have a SALT tax cap risen up to 40K. What does that mean? So prior to the big beautiful bill, the TCJA, the Tax Cuts and Job Act, had a state tax limitation of $10,000. So that meant if you had property taxes greater than $10,000, you could not report more than $10,000 in state taxes. The state taxes that were deductible were property taxes and sales tax. We'll talk about some other stuff when it comes into play here in just a second. Salt taxes, there were some workarounds. Some of the states made it so that if you're a business owner, you would pay your state income taxes at the business level. That would help increase your salt taxes. SALT stands for state and local tax, so that's the acronym. So there were some workarounds put in so you could run some of the taxes through your business and then still take them on your individual taxes. Now, state taxes are an itemized deduction. So the let's see, in 2022 we had 9.5% of the population actually itemized. So we, because of the Tax Cuts and Jobs Act back in 2017, the significant change was to the standard deduction limits, and we got rid of personal exemptions. Standard deduction limit went up significantly high. And because of that, you can either take the standard deduction or the itemized deductions. SALT taxes, state taxes, are an itemizable expense. I have talked about the differences between standard and itemized deductions in prior videos. So most people don't itemize anymore. 9.5% of the population that files taxes are still itemizing, so less than 10%. So some of the stuff doesn't really affect anybody. Okay, go back to my summary here. Okay, so salt taxes. The big advertisement was tips and overtime were not going to be taxable. So that's not exactly how it was written. That was just how it was advertised. Uh, you are still going to report your tips and overtime as filed on a W-2. What will probably happen, the way I see this happening, is there's going to be new boxes on a W-2 that state how much you received in tips and how much you received in overtime. So this is going to cause a little bit of a calculation uh, requirement for businesses to break that out now. You are able, so you're still going to report your full amount of wages, and then you will deduct up to $25,000 in tips and $12,500 for overtime. There are going to be wage or income thresholds on this. So if you are a high net worth person, excuse me, you're in a high paying job, chances are you're not going to get this. It is yet to be determined how we're going to deduct that $25,000 in tips or the $12,500 per person overtime. So the idea is that it's still $25,000 for overtime if you're married filing joint, and $25,000 in tips, or $50,000 in tips, I guess, if you're married filing joint. Um, if you are in a high net worth bracket, you're probably not going to get this. And it's been yet to be determined how this is actually going to get deducted. This could be considered an itemized deduction. So this would be a way the IRS actually circumvents the bill, makes it an itemizable expense instead of an actual true deduction. So yet to see how that's going to play out. Again, if it is marked as an itemized deduction, then uh, and only 10% of people actually itemize, and typically those 10% have some very high are worth a lot of money, mainly because they're doing large charitable contributions and they've capped out medical and the state deduction limits. So we'll see how that one plays out. Hopefully, it rolls out the way it's supposed to be, and you'll basically claim your W-2 wages. And right below that, you will say, well, this amount was tips, subtracted out, and this amount was overtime, subtract that out. Again, it's going to be limited based on income levels, AGI, adjusted gross income, and where it's actually going to end up being reported on the 1040. Who knows? Senior deduction. So it was determined that, again, it was said that we're not going to tax Social Security. Seniors now get, if you are 65 or older, you get a $6,000 deduction per senior, $12,000 for married filing joint if you're both over 65. Again, it is yet to be determined how this is going to actually play out. So Social Security already was tax exempt for certain income levels. Social Security, basically, if all you lived on was Social Security, you didn't pay any taxes. If you have high earnings, again, this is getting phased out. So if you're still in those high earning levels, you're still going to pay the same tax on Social Security. You're probably going to phase out of that $6,000 deduction. And again, it's a deduction, so we don't know where it's actually going to come into play. So just like W-2 wages, there's a line specifically for Social Security benefits. And then there's another form that calculates if it's taxable or not. They could just make this another itemized deduction. They could put it on the face of the 1040. They could throw it on that calculation form for actual taxable Social Security. Who knows where it's actually going to end up and how it plays out? My personal preference or my personal thoughts is that the IRS usually does everything they possibly can to make you pay as much in taxes as they can get you to pay. So I'm betting both of these end up on the standard deduction or on the itemized deduction Schedule A form, where they're going to have the least impact to taxpayers, which is going to actually go against supposedly Congress's intent on this bill, but yet to be determined. Um, here's one that I've seen a lot of advertisements for this. This one is being missed advertised. Um, People are hearing that I've seen advertisements that say you can get back money on your insurance, your auto insurance. You can get back money on your interest portion of your loan. None of it's true. What this is auto loan interest is now a deduction on US made vehicles. So if your vehicle is a US made vehicle, so basically Ford, GM, Dodge, and they might even account Toyota because there are Toyota manufacturing plants in the US. But so if you have a US made vehicle, you can take up to $10,000 per year for auto loan interest. Well, interest is an itemized deduction. Uh, we just got a new itemized deduction. For $10,000, this is not coming through any insurance company. This is not coming from your bank. This is not coming from some app through a third party. This is a deduction you report on your tax return to save on taxes. If you are in the 15% bracket, you're going to save $1,500 in taxes. That's how this works. Um, that's if you end up claiming it at all, because again, this is going to be its interest. It's going to go in the interest section of the itemized deductions. Are you even going to itemize is the real question. Okay, so here's one that's actually going to be good for parents. The child tax credit had a permanent increase from $2,000 to $2,200 per child. That's just going to be a basic increase. If you have children, you're going to get it. This isn't going to be one that the IRS can actually really play with because the way it's reported is already implemented. We're just increasing the threshold. Um, Another thing you can do now is there's going to be a $1,000 grant per child. Uh, well, not a grant. Grant's the wrong word to use. It's a tax deferment investment. So we have quite a few child investment programs already. This is just one more. So you have things like the College Savings Fund, the 529 plan. Uh, you can do, there's like some different insurance programs. You can put money into, you can start 401ks or IRAs for your kids already, you know. So there's already certain things that are tax deferment investments. Um, so you now can do a specific one for children born from 2025 to 2028. You can start a $1,000 tax deferment investment for your kids. Again, we'll see how this is actually implemented. I do want to caution this is a tax deferment. Personally, and what I tell all my clients, tax deferments are bad. They mean we pay low taxes today and then you owe a lot of taxes later. The IRS figures out how to get their money some way. Tax deferments are bad. Permanent tax saving strategies are better. Um, Somebody's going to pay the tax on this $1,000. It's and it's probably going to be your kids when they pull the money out when they're 18 or however old they are when they pull the money out, they're going to owe income tax on this. So maybe if you're still having kids for the next 3 years and you are in a high tax bracket, you can put $1,000 into an account for your kids, and then they pay the maybe the way it will work out. You'll defer taxes at a 36% bracket in order for your kids to pay taxes on it in a 10% bracket when they're in college. Who knows if that's how it's actually going to play out, but that would be one way you could use this to actually benefit you. But typically, the average U.S. citizen, when they're having kids, are usually poor. Most kids are born on Medicaid. So you're going to be deferring taxes at probably 10% for taxes at probably 10%. And you're just going to probably pass it on to your kids. So who knows if this is actually going to be beneficial. To tax deferment strategy, I say stay away from it. Uh, there is a remittance excise tax starting in 2026, a 1% fee on foreign money transfers. So if you are trying to hide money overseas or you are doing business overseas, money that you transfer is going to be subject to a 1% federal government tax. So, again, just one of the ways that you're going to pay more taxes. Clean energy credits, they're going to phase out by 2027. Basically, we've had these energy credits for a while now. Um, energy efficient remodels in your home. Basically, you put in a new HVAC system or furnace, appliances, windows, buying EV, electric vehicles, wind, solar incentives for installing solar panels or wind turbines in your house, stuff like that. That's going to start phasing out in 2027. So these credits are going to start disappearing. I never personally felt like they worked the way they were fully intended. There was a lot of, in my opinion, fake advertising around them anyway. Yes, there were some credits available. They were, in my opinion, never as good as they were always advertised to be. Because again, there was always income limits on all of these things, and the people who actually needed the credits could have used the credits, couldn't afford to even put in the stuff or buy the EV. And those that could afford it, because this technology is expensive, they weren't fully able to take advantage of the credits because of phase out limits. So um, they're now going away in 2027. So those are kind of the big tax things. Uh, we'll see how this actually plays out. If you're overly interested in doing more research into this or trying to figure out how it's actually going to benefit you right now, I would say don't waste your time. Everybody is wanting to know how taxes are going to be affected by the big, beautiful bill. No one knows yet. We're still waiting on the IRS to actually read the bill, interpret the bill, and then come up with how they're going to facilitate and regulate the bill. So they're going to be writing a whole bunch of Internal Revenue Code, IRC, about this bill, and that's going to determine how things are reported and taken. And then they're going to draft forms uh, based on IRC. So, more to come. Gonna have to wait to see how this plays out in the next really 6 months. And then it's going to take 5 years for any of this stuff to actually get challenged in court, precedent set, and things to change. So hopefully the IRS does what we all want and actually makes some of this stuff meaningful, but that's yet to be determined. So anyway, hope you have a great weekend. Hope this was some good information for you, and uh, I guess we're standing by to stand by. Have a wonderful weekend.